You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to The Builder's Mindset. Thanks again for listening. We are so grateful that everybody showed up, and as you all know, we recently hit our 52nd episode, and we just can't be more grateful for everybody who's listened to even one episode, and we're excited. Earnings season is, kind of wrapping up right now. As a matter of fact, it's sort of rolling into the next round of things, and so a couple of builders, a couple months ahead. And so Toll and KHOV have already reported their third quarter earnings because of the way their cycle is. They both end their fiscal years in October. So their Q4 is August, September, and October. So they finish their Q3 at the end of July. But, I love earnings season, but there are parts of earnings season that bring up things that just drive me crazy in the industry. It's how quick people grab onto headlines without ever looking at the math behind them. And I will say that was the impetus and the reason we at the Builder's Mindset started doing the earnings report summary was not to sort of, crunch a bunch of data that we feel like we could crunch. There are great organizations out there who love to do that stuff. Really more what it was is I got frustrated with the people that I know and deal with talking about whether it was, big builders are doing great and they make so much money and or their margin, or like other people like outside of the industry going, oh my God, the economy is going to crash and whatnot. And so we started doing the earnings report summary because it's public information. And no matter how many times I kept telling people that I know to listen to earnings reports or read the transcripts or look at their filings, nobody ever does. And so it just drove me crazy. So that's why we've been putting it out now. And I think we're coming up on, I think we've done 5 or 6 now. And we're excited. And so what we're going to start doing now is, since Toll and KHOV end their quarter 2 months before most of the other builders, and then Lennar and KB are a month ahead before the major builders, I think there's 19 public home builders that are left. We've got 2 that'll report early, and then 2 a little early, and then all the rest. So we wanted to dive into it and see, if we could get people to think about things a little bit deeper. We see every quarter in earnings season, the media tends to shout like the headlines that are going to sell, whether it's profits plunge or record revenue. It's always some number that is an extreme of like record sales. We haven't had this many starts since then or whatnot. But this business of home building is really about fundamentals, and it's about disciplined execution of your fundamentals. They don't have to be the same. And drives me nuts when people just grab onto those headlines and then they don't even really dig into the details to figure out what's really going on. So today, I'm not going to get political per se, but I am going to dig into something that gets thrown around in headlines without too much context often. Earnings season. I want to peel back 2 builders we're going to talk about is Toll and KHOV today, or Hovnanian Enterprises. They just reported recently their Q3 2025 numbers and what those results actually say about the housing market we're living in. So now let's put this into context. So we just rolled into September, and so most of the builders, so essentially Lennar and KB just finished their Q3. But their numbers won't come out for about 3 to 4 weeks from now. So their Q3 ended at the end of August, but Toll and KHOV, their Q3 ended at the end of July. So we get kind of a little pre-glimpse into it in terms of it slides the numbers forth. So when we do these, what I'd like you to think a little bit about is, yes, it's Q3 for them, but it's really more like a late stage Q2 for the majority of the home builders. So what I think is interesting is if you watch what they do, it can tell a slightly different or a reinforcing story to what's going on with the builders who just reported for Q2. So let's dive in and let's go beyond the headlines, as we like to do here at the Builders Mindset. And here's the thing: when the media covers builders' earnings, you usually get those extremes. We talked about that. It's either doom and gloom, profits plunge, or it's overly rosy. Record revenues. This comes back to that we talk about the rising tide. Look, if you want to be a tide following builder, like, go for it. You know what I mean? Then you're going to end up when the tide's out, you're going to be whining and complaining and crying. When the tide's in, you'll be reaping the benefits. But we here at the Builders Mindset believe in, not that you can't eliminate the tides, but let's move somewhat with the tides by being operationally disciplined in how we execute what we execute. So what's the missing middle ground there? It's the truth. It's the why behind the numbers. And that's where we come in, because we've lived in this business for over 2 decades. We've seen ups and downs. I've seen the cycles within a year. I've seen the cycles within multiple years. I've seen builders execute well. I've seen builders execute horribly. I've seen divisions doing great. I've seen divisions doing not great and then get to great. And then I've seen divisions not great, get to great, and fall back to not great. There's a really interesting take on the book Good to Great. I believe it's I think it just recently had an updated version, but it's really interesting to watch when leadership changes at a divisional level for a builder, how that impacts the overall performance. Do they stay the same? Do they get better? Or do they fall by the wayside? And so I think a lot of times we like to follow the tides, because if the market's struggling and the division struggles, we have an excuse. We very rarely take the opportunity to, and it would be hard to quantify anyway, is to say, let's say hypothetically that the industry is down 20%, but you're only down 10% because you execute, flawlessly. It's very hard to measure that. But what I think is easier to see is, generally speaking, there are your leaders and your laggards, and your laggards tend to just kind of flow with the tide. And so they sort of have this really, whereas the leaders tend to have discipline, have a strategy that they're consistent with, and they stick with that. And it doesn't mean the tide doesn't affect them, but they are affected less by the tide, except when the tide is going out, they're affected less. When the tide is coming in, they can capitalize on that more. So they're going to shift their curve to the positive side. So let's dive in, though, and see what these couple of builders' early reports are coming. And like I said, this is more like Q2, but we've got July in the mix now. And start with Toll. Toll posted record Q3 revenues of $2.9 billion, up 6% year over year. Doesn't sound like the headlines that we're hearing. Also doesn't sound like some crazy 15, 20% COVID style numbers. Their deliveries grew by 5%, and their average selling price ticked up to nearly $1 million. They're about $974 nationally. This is the luxury segment at work. Their buyers, 26%, are all cash, with the rest putting down serious equity. I think most of their not all cash buyers are, I want to say something like, I think it's over 70% have a less than 70% loan to value ratio. But what I find interesting here, and my hat's off, and I've said this a couple times before, because Toll has really been executing very well, in my opinion, over the last 12 months and beyond. They're a great company with a long pedigree, but as you all know, it's not my forte. I am not a high-end luxury builder who likes a massive option program. I like simple. I like streamlined. Think In-N-Out Burger. Think Tesla. I am not your Cheesecake Factory guy. I am not your BMW kind of like purchase option. But I got to give credit where credit is due, and they are actually performing really well when it comes to their sales price, when it comes to still their cancellation rate, when it comes to their margins. they are really, really doing well. Now, there is a catch, and their backlog is down. And so this is what we talk about. We want to get deeper into the numbers. This is across the board. Just about every builder's backlog is down right now. If you're not, I know a lot of you know what backlog is, and so essentially, but just for any of you listeners who, we do have a bunch of listeners who are a little bit more they like to learn about the home building industry. So your backlog is essentially the dollar value and number of orders that you have already contracted for, but have not yet delivered on those homes. So it's future orders. Think about it, their future orders are down. Every builder's units fell 19% year over year in their backlog, and their margins did also slip to 25.6%, about 180 basis points lower. But hear that number, 25.6%. Toll's luxury market is on just about every metric except backlog, and everybody struggling on backlog are holding very steady. Down doesn't, remember the example we gave, when the tide goes out, are you just letting the tide suck you out as far as it's going to go? Or is your operation, your discipline, your consistency, and your platform helping keep you as close to shore as possible? I believe that's what Toll is doing. They are holding the line by focusing on price over pace. In plain English, they'd rather sell fewer homes but keep margins strong. Just like other builders have the same. We talk about it a lot, pace over price. What I think is really interesting though is they have found a really good balance. Their margins are still solid and strong. Their sales are still solid and strong. Yes, their backlog is down, so we're gonna have to watch what comes out from them over the next couple of quarters. But my belief is they have found a niche in a market for that. I think one of their target markets is the dual income millennial, where they've got a lot of cash, potentially got some savings. They have found their stride in what I would call that second move up market, and they're executing on it. Psychologically, this is important. Luxury buyers aren't as rate sensitive. A lot of talk about rates. We're all waiting for rates to come down. Once again, that's another headline that gets people riled up. Do lower rates get buyers to come out? Yes, but as we've said in the past, I do not believe that lower rates will create a marginal impact on the large public and private, like the well-capitalized builders. I don't think it's going to have a significant impact on their sales. They're already buying rates down to $499. I just saw an advertisement at a community for a Meritage Homes community. They're taking it down. They've got an ARM at a 4.5. So read the fine print. The actual percentage rate is 6.2. You got to dig into the weeds, and there's a lot of marketing games, I think, that get played around interest rates, and the Fed rate doesn't guarantee that mortgage rates come down anyway. But I don't think that's going to be the big thing that impacts. But for Toll, because so many of their buyers are cash, interest rates don't matter to them. Because so many of their buyers that are not cash have a lower than average loan to value ratio, it's not as important to them. For them, a mortgage moving from 6 3/4 to 6.5 or 6 1/4, it's not about really affordability. It's more about confidence for them. And so that brings up another thing. They'll buy when they feel good about the economy or okay. They'll hold off when they don't feel good about the economy. And this is where this interest rate thing gets unique, because generally speaking, savvy buyers know, which I would put Toll's buyers in this category, lowering interest rates typically is a signal of a softening economy. So be careful what we wish for when we ask for lower interest rates, because in some circles, that might not be the best signal we're trying to send. But Toll understands this, and that's why their strategy works. Hovnanian, on the other end, will contrast their strategy, which is different. Their Q3 revenues also climbed 11% to $801 million, but their net income collapsed 77%, with earnings per share down 80%. Why? Because they're deliberately prioritizing pace over price. Is this the right thing to do? I pause there for a moment. Is it the wrong thing to do? No. Is it the right thing to do? No. As we've talked about in our community, what do we say? The right thing to do is have a strategy, implement that strategy, and stick to that strategy and make micro pivots to execute better on that strategy. When you make a strategy plan to go pace over price, you need to stick with it for a while. When you make a strategy of going for price over pace, you need to stick with it for a while. When you turn on a dime every quarter for whatever reason, oh, we didn't quite hit the number of sales we wanted and we're already struggling on our margins. Oh, Wall Street penalized us because our margins are down. Oh, Wall Street penalized us because our sales were down. And you pivot, that signals weakness and a lack of confidence in your strategy. But listen, 3 out of 4 buyers used mortgage rate buy downs in Q3 with KHOV. They leaned into quick move-in homes. Over 1,000 of them they have available because they know today's buyer isn't waiting 9 months to build. They want certainty. They want to lock a rate now, move in 60 to 90 days, and get on with life. And that's the buyer that KHOV is going after. So in the short run, is that going to hinder them in certain metrics? Yes, it absolutely is. But now what they can do, now that they've kept the volume and they've increased their revenue, yes, their income's down, right? Because their margins are down. So yes, their earnings per share are down. Absolutely. Like all of that is a factor of making these decisions. Now they can go and leverage the volume. Case in point, look at what Lennar's doing. They're going to continue to maintain their presence and dominance through pace. Now they can make micro adjustments to either adjust their spec to save costs, renegotiate contracts to get costs. Now they have something to go back to trade partners and say, see, we told you we were going to commit to this number of deliveries. We delivered on it, so now we're coming back and we're going to ask you for a price reduction. Be prepared for that. If you're a trade partner working for KHOV, wait for that phone call if you haven't got it already. Look, that strategy drives contracts per community higher. It was 9.8 over the quarter, divide that by 3, so we're talking about 2, so 3.2 per community. What have we said consistently here? You know, this is at the Builder's Mindset, one of our favorite metrics of a health of a community, of a division, is the number of sales that they get per community. That's because we subscribe more to, and the builders that we tend to work with focus more on pace over price, more true production rather than personalized and custom. And so it's in that strategy. If you're going to choose pace over price, you want to be over 3. They're over 3. So let's not go gloom and doom on the reduction in income and earnings per share. Let's see if they continue to execute and get back some of that margin. I think they set a new baseline. What I'll be looking for with KHOV in their fourth quarter, which we'll be able to talk about, let's say like in November-ish, we'll be able to talk about that. I will be looking for, are they maintaining or increasing their revenues, and is their net income and gross margin up sequentially? I know we like to look at these metrics year over year. I get that, but we're going to want to look at it sequentially and see how it is sequentially. If we want to get really creative, what we can say is net income collapsed 77% year over year for Q3. Let's look at the compression of that number from Q4 24 to Q4 25. So there's a couple of different ways we'll take a peek at it, but they have the pace, they're sticking to the pace. Let's see if they can make the micro adjustments to get their margins to start moving in the right direction and tracking behind that. So you know, the pace is above their long-term average, and it does hinder margins for sure. Their adjusted gross margin dropped to 17.3%. Not exactly where you want to be. What we said is right now, we're going to call that salt line 20% or better is really where you want to be, unless, of course, you're Lennar. Lennar is higher than them. I would expect them to be that. You know, in this new normal, we'll have to see how things work out. We might make an adjustment for what we think is the new threshold. I might be inclined to sort of say for the foreseeable future, the next year or two, that maybe 17.5 becomes the threshold for those builders that are pushing pace over price. But let's see how that goes. But their 17.3% adjusted gross margin it's down nearly 500 basis points year over year. So it's a tough one. They've got some recalibrating to do, but let's see if they can not flinch and stay focused on pace over price. So this is a psychology of trade-offs. Sell homes now, clear older land, and keep communities moving, but at a cost, right? But you can't stagnate, okay? You have to sort of throttle things back. You can't get stuck in the mud. You've got to keep moving forward. So, here's the tension overall. What does this mean deeper for the market? Toll Brothers is saying, we'll take fewer sales, but keep our luxury margin machine humming. They're okay with, more like 2 sales per community per month. Hovnanian is saying, we'll move homes at all costs, even if it means eating into margins. We're going to go off of that momentum. We're going to get that faster momentum, keep things going. Neither strategy is wrong, like we said. Neither one is wrong. It's just playing to the customer base that you're after. Is your strategy attuned to the right customer base? And one's a high income, confidence driven buyer. The other's a middle market, affordability strained buyer. So you just have to be focused to the customer you're going after. Set your metrics, your execution expectations around that, and then go and execute. So, the bigger truth, they both highlight the real divide in the housing market. The affluent can still buy. They can still upgrade. I think Toll's upgrades were an average of $200,000 per home, and they could still pay cash. The rest are still juggling incentives, rate buydowns, and quick move-ins to make deals work. Neither strategy is bad. You can't flip on a dime from being an entry-level first move-up buyer to being a luxury buyer, and you can't go the other way either. So my advice, as we're right now, wherever you're at, look at where you're at as a builder. Look at what you're closest to. What is your systems set up mostly for? Higher end or more entry-level first move-up or second move-up and personalized, customized? What are you more attuned to, even at the division level? Some of the larger builders who don't have a national strategy, look division by division and say, what are you really good at? What have you historically executed well at? Let's double down on that. Let's focus on that. And let's continue to execute in that demographic as best that we can and make it through 25, 26 and beyond, okay? And then if you want to pivot because you see something bigger, longer term, put that pivot strategy for more of your 2027 goals. You can move. You don't have to stay the course. If the ship is sinking, you can change. But what I say is, if your ship is not sinking, execute on what you're currently doing. And if you want to pivot, do it in a longer term strategy. So look, what does this all mean for us in the industry? It means you have to know your customer. You have to know whether you're building for a Toll type buyer or whether you're buying for a Hovnanian type buyer. The psychology is different between these two. So your marketing strategy should be different. Your product type should be different. But it does not take away the act that you still need to be a leader and focus on who is that customer, how do we execute and deliver for them as cost effectively and as efficiently as possible, and focus on those fundamentals. The lesson's this: you can't headline your way out of the housing reality. And when I hear people talk about it, and 9 times out of 10, when people come to me and they say, hey, what do you think about this? What the root happens is they read a headline. They didn't really dig into the data. That's what we're trying to help you understand here. Numbers don't lie, but they don't tell the whole story either. That's why we have to dig deeper here every week. We help you think about who you are as a builder, who's your customer. Let's look at your product. Let's look at your execution, your options program, your team, and let's look at how you're executing. Do you need to change or add processes? Do you need to change or modify product? Do you need to change or adjust people? Do you need to change or adjust processes so that you can execute efficiently and effectively for the buyer type that you're going after? As always, we thank you for showing up. If this episode resonated, share it with somebody in the industry who you think could use a little perspective beyond the headlines. Click subscribe, drop me a note with your thoughts, and stay tuned, because next week we're going to take this conversation on trade capacity even further. Have an amazing day. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.